Imagine waking up one morning and discovering that your retirement savings are gone, not because the market crashed, not because of a war, but because one company lied for years and nobody noticed. Not the investors, not the journalists, not even the experts who were supposed to protect the public. At the end of the 1990s, there was a company that seemed unstoppable. Wall Street loved it. Politicians praised it. Business schools studied it. Financial magazines called it one of the most innovative companies in America. Its executives were treated like visionaries. Its stock price kept climbing. And millions believed they were witnessing the future of business. But behind the scenes, something terrifying was happening. The profits were fake. The success was an illusion. And when the truth finally emerged, it triggered one of the biggest corporate scandals in history. This is the story of Enron, the billion-dollar fraud nobody saw coming. To understand how this happened, we need to go back to the 1980s. Enron began as an energy company. At first, it was a relatively ordinary business. It transported natural gas through pipelines across the United States. Nothing glamorous, nothing revolutionary. But in the 1990s, America was changing. Markets were being deregulated. Technology was transforming industries. Investors were searching for the next big thing. Enron saw an opportunity. Instead of simply selling energy, it wanted to become a giant trading platform. Think of it like turning electricity into something that could be bought and sold as easily as stocks. The idea sounded brilliant, and Wall Street loved it. By 2000, Enron was worth more than $70 billion. Its stock had increased by more than 1,000% during the decade. Employees invested their retirement savings into company shares. Investors poured in billions. Everyone wanted a piece of the miracle. But miracles are often dangerous, especially when they're built on numbers nobody fully understands. So how did Enron fool the world? The answer lies in accounting. Now, accounting sounds boring, but in this story, accounting became a weapon. Imagine you own a lemonade stand. You expect to earn $10,000 over the next 10 years. Normally, you would record profits as you actually earn them. Enron did something different. It recorded future profits immediately, even if the money had not arrived, even if the project eventually failed. This practice was called mark-to-market accounting. On paper, profits exploded. Reality didn't matter. Expectations became earnings. But there was a problem. Many projects weren't making money. Some were losing huge amounts. So Enron created a solution: hide the losses. Executives built hundreds of complex partnerships. These partnerships existed largely to move debt away from Enron's official balance sheet. Imagine stuffing all your unpaid bills into a secret drawer before showing your finances to a bank. To outsiders, everything looks healthy. But the debt still exists. It has simply been hidden. The company became a giant financial illusion. Investors saw profits. Analysts saw growth. Employees saw opportunity. Yet beneath the surface, billions of dollars in losses were quietly accumulating. The higher the stock price rose, the more important the deception became. Because if investors ever stopped believing, the entire structure could collapse. And eventually someone started asking questions. In 2001, the cracks began to appear. A few journalists noticed inconsistencies. Some analysts became suspicious. Then a company insider made a shocking warning. The message reached Enron's leadership. It described serious accounting problems large enough to destroy the company. At first, executives tried to contain the damage. Publicly, they insisted everything was fine. Privately, panic was spreading. Then the truth started leaking out. Hidden debts, fake profits, off-the-books entities, conflicts of interest. The illusion began unraveling. Investors rushed for the exits. The stock price collapsed. From more than $90 per share, it plunged towards zero. Employees watched their retirement savings disappear. Many were unable to sell their shares in time. Entire life savings vanished. And then came the moment nobody thought possible. Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in American history. The company that had been celebrated as a symbol of innovation had become a symbol of fraud. The emperor had no clothes, and suddenly, everyone could see it. The fallout was enormous. Thousands of employees lost their jobs. Investors lost billions. Trust in corporate America was shaken. One of the world's largest accounting firms, Arthur Andersen, collapsed after its role in the scandal was exposed. Governments responded with new regulations. Corporate reporting rules became stricter. Executives faced criminal investigations. Some went to prison. But the damage extended beyond Enron. People began asking a deeper question. If one of the most admired companies in the world could hide the truth so effectively, how many others were doing the same thing? The scandal revealed a dangerous reality. Markets depend on trust. And when trust breaks, entire financial systems become vulnerable. Enron wasn't just a story about greed. It was a story about belief. People wanted to believe. Investors wanted easy profits. Analysts wanted growth. Executives wanted admiration. Everyone benefited from the illusion. Until reality arrived. The most dangerous frauds are rarely obvious. They succeed because they tell people exactly what they want to hear. That's why Enron still matters today. The technology changes, the industries change, the buzzwords change, but human nature remains the same. Whenever an investment seems too perfect, whenever profits seem effortless, whenever nobody is asking difficult questions, history suggests caution, because sometimes the biggest risks are hidden behind the brightest success stories, and by the time the truth becomes visible, it's already too late.